A few days ago, I released a video covering the top growth stocks to buy for the month of May. And I said to expect some volatility, especially over the summer months, and we were waiting really for Jerome Powell to have his commentary today. So the Fed raised rates today by 0.25%, and there's still not a whole lot of clarity if they're going to continue to raise rates, they're going to pause, and it might be quite some time before they actually start reversing and cutting rates the other direction. So I still believe that we have some opportunity to accumulate. We're really going to be trading in a range for the next several months. And so today I've got 7 stock picks. These are dividend stocks. These are on my watch list. I own a few of these stocks as well, and I think they're attractive at these levels and lower for the month of May and really over the summer months. So this video is going to be rapid fire covering 7 stock picks. Let's get started. The first stock pick is a fired up wealth favorite. It's Tractor Supply Company. And I'll admit that I wouldn't mind this stock being a little bit lower, but it's not crazy expensive here. For each of these stock picks, I will give you price targets that I'm looking at as well. And some of them are going to be lower than they are trading at right now. So Tractor Supply Company right now is trading just under a 25 PE ratio. It pays you a 1.7% dividend yield. Now in the 52-week, this was $166 here back May 25th, 2022. And we really just hit the high recently, April 21st, 251. The overall market's actually selling off after Jerome Powell spoke, but Tractor Supply Company is up. So if you're not familiar with Tractor Supply, they offer a lot more than just tractor parts. So everything from lawn and garden, home goods, tools and hardware. They have clothing, outdoor living, lawn mowers. Now they've made an acquisition not too long ago that gives them more of a presence when you think of pet care and veterinarian services. And the thing about Tractor Supply Company, it is seasonal. So when you think of spring and summertime, they generally have better sales. And Tractor Supply just had earnings here late April. You can see it missed on top and bottom lines. So Tractor Supply for me is something that I want to hold long term for 5 or more years, and I'll get to a price target here in a second that I have in mind. A couple key milestones from 2022. The first one that really sticks out, 30 years of consecutive sales growth, and second, they have over 28 million of their Neighbors Club members. That's up 20% year over year. Now I just told you they missed on top and bottom lines, but they did confirm their full year 2023 outlook, and you can see the numbers on your screen. Net sales are $15 billion to $15.3 billion. So when you look at that top and bottom line miss, I think some of those estimates were pretty aggressive. And you look at the actual growth numbers, they're pretty strong. Revenue growth over 3 years, 19.37%. They have $498.5 million in free cash flow. And that cash flow growth has been pretty impressive as well, 23.6% over the last 3 years. So this is about a $31 billion market cap. And you can see the price to sales ratio is 1.85. The PE ratio for next year's estimate is a 20.9. So for me, Tractor Supply Company, the target would be $240 or less. I prefer $220 or less, but you might not get that. And with all these stocks, I would use dollar cost averaging, just buying a little bit over time. Don't buy it all at once. The next stock is BristolMyers Squibb, BMY. Now this is actually pretty close to the 52-week low, which is $65.28 back March 13th, 2023. The 52-week high was December 1st, 2022 at 81.44. Now this is trading under a 20 PE ratio, and it pays you a very healthy 3.348% dividend yield. One of the reasons that the stock has seen pressure is their longtime CEO is leaving the company. Now I did some homework on this, and the person that's going to be replacing that CEO has been with the company for a long time. And from the looks of it, I think he'll do well. So this is a $173 billion company. Price to sales ratio here is 3.14. The PE ratio for next year's estimate is only an 8.4. Now this PEG ratio on Fidelity says 5, but I don't think it's correct. According to this quick search, it's about a 1.37. That's based on the forecast 12-month forward PEG. And that is attractive. Of course, with pharmaceutical companies like this and biotech, these guys did acquire Celgene, if you remember that company a few years back. So they're doing more in cancer research. And the pipeline is going to be really important. There's 50 plus compounds in development, 40 plus disease areas being studied. And if you look through this, it's a pretty impressive pipeline. There's a lot going on here. And I think this company is set up to do well longer term. This isn't going to be a hyper growth type story, but it's paying you over a 3% dividend. It's not crazy expensive. And I think this company can do well. I would treat this more as a DGI stock. So looking for dividend growth. It's not going to be like that DGIF type play that we look for in Fired Up Wealth, where it's giving you that growth on the dividend and growth in the share price, but a solid DGI play. And for BMY, I'm looking for 65 or less dollar cost average afterwards. Check it out. Ticker is BMY. The third stock, I've liked this one for a while. It's MRVL Technology, and it ran up like a lot of stocks, and it's come back down to below $40. It's trading at $39.56. 52-week range is $33.75 to $63.11. This is going to be a $33.69 billion mid cap. It's going to pay a dividend. It's a 0.6077% dividend yield. According to Fidelity, the PE for this year's estimate is 25.8. Next year is 17.1. The price to book is about a 2.16, and the price to sales ratio is 5.69. And the company will be reporting earnings on May 25th, so keep that in mind. The reason I like this stock, and I've liked this stock for a while, but this actually is an AI play, and it's not really getting much attention for that. So I like it for the data center. They're also doing more with EVs and automotive. And I want to show you a clip. This is from a Goldman Sachs analyst, and I think it's spot on, and I agree with this analysis.
And this environment that's never been this bullish on AI, which is an area our next guest is excited about, but not on the names you might expect. Joining us at Post 9 today, Brooke Dane, portfolio manager for Goldman Sachs Asset Management, is back. It's great to have you. Welcome.
Great to be back. Thanks for the time.
The knee-jerk is NVIDIA. How much more creative can we be?
It's so early in this wave of AI coming in the marketplace that there aren't a ton of public market vehicles that you can look at and say, that's the pinpoint thing. And as you said, the market's gravitated across a couple big winners. We think, though, two things. First, as we move through this year, there's going to be a lot more companies that you're going to see actually having AI power their business and create higher growth and higher margins. But secondly, there is at least one name that we think in more of the picks and shovel side that the market's missing its leverage to AI. So at companies Marvell, Marvell's core business is doing connectivity in data centers. One of the key bottlenecks, besides using GPUs, is this connectivity issue. And we think that as the big platforms continue to spend on AI, they're going to continue to invest behind Marvell's connectivity solutions. The other piece of Marvell, and what we think is actually even more attractive, is what they're doing on the ASIC side. And here, if you think about the architectures of the big platforms, it's been heavily GPU-based. They're going to move to a world where they're balancing both GPUs and ASICs. And again, we think Marvell's really attractively positioned for that.
So for MRVL Technology, I like this stock below $40 dollar cost average. Of course, if you can get it below 35, even better. Check out ticker MRVL. Up next is another fired up wealth favorite. This is John Deere. It's trading right now at 382. I'm going to tell you a price target here in just a minute. PE ratio is a 14.24. It does pay a dividend. This is a 1.3% dividend yield. Large cap, $113.73 billion market cap. Now the 52-week range is kind of all over the place here, 283 to 448. So PEG ratio on Deere is a 1.04. That is attractive. And the PE for next year's estimate is a 12. Now I recently covered John Deere. I'm not going to go into too much detail on this video, but you can see the breakdown: production, agriculture, small ag, turf. They have lots of different product lines, even forestry and road building. Now I like this because I think it's more of a technology play longer term. When you think of autonomous tractors, electric tractors, you think of drones, but it's a high quality company. It's not an expensive stock. It pays a nice dividend. They've been doing tons of share repurchases, and that dividend keeps increasing as well. This is the dividend growth history here from 2012 to 2022 over the last 10 years. So the GAAP PE ratio is currently around a 14.3, and it's below the 3-year average of 19.8. So I actually like this stock right here. 375 or under. I mean, I'd prefer it 350 or less, and it was a steal when it was under $300, but you're probably not going to see that again. Now, of course, with this stock and several stocks on the list, if you go into recession, you could see more pressure, and that would be an opportunity for a company like this. An industrials type company is going to get hit in a recessionary period. But assuming we don't have that recession, we have a soft landing, and really just thinking long term, if I'm holding this for 5 years, I feel like this stock will be worth a lot more in 5 years than $382 a share. So check out Deere and Company, ticker DE. Now, I struggled with this next pick. I debated between a couple different banks, and you have to be careful right now with banks. But when you look at these larger banks like JP Morgan, Bank of America, I think they'll probably do fine. They're seeing additional pressure when you think of the overall industry getting shorted and selling off. So Bank of America right now is below a 9 PE ratio. It pays you a 3.125% dividend yield. It's a mega cap, $224 billion market cap. And of course, there's risk with all stocks. But if you're trying to pick a handful of stocks that are in the financial sector that have really lower risk than others, I think Bank of America fits fits that bill. So BAC is trading right now at a price to book of 0.89. Price to sales ratio according to Fidelity is a 1.72, and the PE for next year's estimates around 8.4. This is something that we've talked about in Discord. I like Bank of America under $28 dollar cost average. The low so far was $26.32 on March 24th. If it ever gets below 25, I think it's a pound the table type moment, but I like it right here under $28 DCA, thinking long-term 3, 4, 5 years. So this next stock pick has almost $1 billion in cash. It's $992 million in cash, and it's trading at a very reasonable valuation. I'll get to that in a second. So recent information from the quarter, $166 million in stock repurchased. New products with Cisco unveiling Wi-Fi 7 networking and so on. The number one risk with this company, Apple, is about 68% of revenue. But the bull thesis, mobile network traffic is expected to double in 2 years. Over 25 billion Internet of Things devices installed by 2027. And Skyworks at a glance, 17 countries, 11,000 employees, 7,600 unique products, 6,000 customers, $5.5 billion annual revenue, over 4,600 patents. So think mobile internet users, connected cars, mobile cloud gaming, 5G, 6G, anything with a G behind it, mobile AR and VR technology, and high def everywhere. And this is a good snapshot here. So Internet of Things, all these different segments here, automotive and industrial, infrastructure and defense, and then you've got audio and gaming. So Skyworks Solutions is trading at $105 a share. Now the 52-week range is 76 to 123. It was $76 back October 13th, 2022. This is a 14.39 P ratio. It pays you a 2.35% dividend yield. It's a mid cap around $16.7 billion market cap. They report earnings on May 8th, so be aware. So price to book is a 3.02. PEG ratio below 1. That's what you want to see. It's 0.96. The PE based on next year's estimate, only a 9.8. So here's my plan for Skyworks Solutions. They report earnings here soon. If there's a miss and this stock goes back below $100, I would DCA under $100 thinking long term. The number one risk really comes to the exposure and concentration with Apple. And if you're not okay with that, then avoid the stock. But when you think of the positives, almost $1 billion in cash, a PE ratio of 9.8 for next year's estimates, a 2.35% dividend yield. I think it's attractive, especially under $100, even here, but I would wait for earnings. Ticker is SWKS. So I've got one more stock pick, actually two. I'm going to give you a bonus. I'm going to give you a 2-for-1 on the next pick. If you're new to the channel, make sure you subscribe and click the bell to get notifications. I'm trying to get to 40,000 subscribers in 2023, and you can help me out by subscribing today. I also need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. And check out our private community, Patreon Discord at patreon.com/firedupwealth. So 2-for-1 here. The first one's going to be Texas Roadhouse, and it's not dirt cheap, but it is trading lower than it has historically when you look at valuation. With that said, the 52-week range, May 24th, it was $68. It's ran up 100% since then, and you have to be careful. It does pay a 1.94% dividend yield. It's a mid cap, about $7.6 billion market cap. It has 8% short interest, which is pretty high for a dividend paying stock, and it's going to report earnings literally May 4th, tomorrow. Depending on earnings, this stock will pop or drop. My plan with this is if it gets back below $100, I would DCA on it, and it might not happen. It could have good earnings and it could easily pop to 125 from here. So keep this one on your watch list. It's TXRH as the ticker. So pick 7B will be Darden Restaurants. I'm going to give you two restaurant stocks. You can pick the one that you think is better. Now, my favorite restaurant stock is actually Wingstop, but it's sitting around all-time highs and it's over 100 P ratio, so I think you have to kind of wait on that one. But Olive Garden owner Darden Restaurants is buying Ruth Chris Steakhouse for $715 million. That's a 30% premium. So the ticker is DRI, 19.8 PE ratio. It does pay a 3.18% dividend yield, so that is healthy. Mid cap, $18.36 billion. 52-week range is 110 to 155. So it is sitting kind of close to that 52-week high. I think you have to be careful. For me personally, I'd be looking for something around $140 or less a share, which might not happen, but I'm going to put this one on my watch list. Ticker is DRI. Thanks for watching, guys. If this video is helpful, make sure you drop a like and a comment. Make sure you subscribe to the channel. Have a great rest of your day. Take care.